Hi class, this is Team International and we'll cover chapter 11, Debt. My name is Martin Onskulis. I'll be covering the first part of the presentation, then Megan Mazurek and David Trinkberger will take over from there. So let's jump right into it. I think debt is described pretty accurate in this quote by comedian Flip Wilson. If you think nobody cares if you're alive, try missing a couple of car payments. Debt is definitely one of the things that keeps a lot of people up at night. More than 53% of people in the US stress over finances, but not all debt should keep you at night worrying. In fact, some forms of debt should let you dream of a more financially secure future. From mortgages to credit cards to student loans, there are good debts and bad ones. So, what's the difference? Simple rule is if it increases your net worth or has a future value, it's a good debt. If it does not do that and you don't have cash to pay for it, it's a bad debt. As simple as that. Let's move forward. So, overview. So, debt is something, typically money, that's owed or due. There are different kinds of debts. One of them is long-term debt, debt that matures in more than 1 year. So, respectively, financial obligations that extend beyond 12-month period. Why companies would ever use a long-term debt? Simply just basically to obtain immediate capital. Long-term debt can be bonds, individual notes payable, convertible bonds, lease obligations or contracts, pension or post-retirement benefits, and so on. And short-term debt. Short-term debt, also called as current liabilities, is a firm's financial obligations that are expected to be paid off within a year. It is listed under the current liabilities portion of the total liabilities section in the balance sheet. And short-term term, the first and often the most common type of short-term debt is a company's short-term bank loans. These types of loans arise on a business balance sheet when the company needs quick financing in order to fund working capital needs. Another common type of short-term debt is a company's accounts payable. This liabilities account is used to track all outstanding payments due to outside vendors and stakeholders. Let's move on. And history of debt. Credit and debt are basically as old as the wheel. Like that invention, both have been essential to human and economic progress. At the same time, debt has always carried risks. Basically, debt has a really bad reputation. On the one hand, everyone needs it at some point to finance a home or education. On the other hand, too much debt can be risky or even dangerous. Money can be almost anything, including debt from whatever cattle to bitcoins. Money has taken many forms in history. It can be whatever society agrees upon as a currency. Currency of a kind was invented around 9000 BC when cows, sheep, and other livestock were used as money around the world. When we think of as a money came around 1000 BC when metal came into play. Coins got heavy, so the Chinese invented paper money. In 806, which was easier to carry around, it was originally issued as a certificate in exchange for a load of cash, but evolved into modern-style banknotes. Paper money did not become common in the rest of the world until 1700s. After that, reporting. Credit reporting was formalized in Great Britain in 803. A group of English tailors established the Mutual Communication Society of London, in which they exchanged information on bad customers, as simple as that. The tailors realized that the people who did not sell their debts with one shop, often meant to cheat others. And so they shared their names to protect themselves from potential risks. Later on, to more current days, credit cards came around. The first credit cards came into use in 1920s, when companies like Whole Chains issued them for use at their own locations. And in 1950, Diners Club introduced the first universal credit card which could be used in many places. American Express introduced a travel and entertainment credit card in 1958. Bank credit cards were next. They started on a local level with Bank of America's statewide card for California in 1958. It went national in the 1960s and was renamed Visa in 1976. And then recession. Many economists believe that an increase in household debt was a major cause of the Great Recession in 2008 and 9. And comparing in 1950s, consumers rarely took out loans that exceeded their income. So the average debts of 31% of their income. By 2000, the average American had debt of 81% of their income. In the early 2000s, at the peak of the housing boom, household debt was around 1.2 times larger than personal income. Americans took out mortgages, car loans, and credit card debt, balancing multiple payments that outpaced their earnings. So that's a brief history of debt. There are lots of other things to mention, but it's a really, really long history, so we just stick to the major points of debt. Facts. The average household owes $16,091 on their credit cards. Credit card interest costs Americans $1,300 every year. Total student loan debt is more than $1 trillion. There are lots of payday stores in the US, more than actually McDonald's. 12% of Americans expect to die in debt, and 8 out of 10 people are in debt. So it's pretty simple math. Debt and balance sheet. When financing a company, cost is the measurable cost of obtaining capital. With debt is an interest expense a company pays on its debt. With equity, the cost of capital basically refers to the claim on earnings provided to shareholders for their ownership stake in the business. And so debt financing is a tax shield for firms and also provides greater returns for investors. And what does tax shield mean? Tax shield is the reduction in income taxes that results from taking an allowable deduction from taxable income. For example, because the interest on debt is a tax deductible expense, taking on debt creates a tax shield. So basically, in a sense, debt gets substituted for equity, number of shares outstanding gets reduced, and earnings per share goes up. As in this slide, we can see debt and balance sheet. There's one company without debt, there's one more company with very little debt, and one more company with lots of debt. As we can see that interest expense gets reduced, also income taxes, and the next thing, net income also gets reduced for the companies that are in debt. So as annual income tax shield provided by debt goes up for the companies with the debt, and so as earnings per share of common stock goes up. But there's one but. Too much long-term debt can really restrict spending money on operating activities such as marketing, maintenance, training, etc. and therefore have a diminishing effect since company has to pay back debt rather than spend money. Debt ratings. Companies are assessed with a credit rating to determine the creditworthiness of a borrower, company, corporation, or individual. How likely money is paid back if loaned. And credit ratings usually assign a letter grade system. And as a side note, the US still gets AAA rating from S&P Global, a credit ratings agency, due to its relative stability. Banks still believe that loaning the US government money is a safe investment. And just like how you might apply in debt with the student loans and can still get a credit card with the high credit limits, so its use is government. And from here on, Megan will introduce high-yield bonds or junk bonds. Thank you.
Thank you, Martins. My name is Megan Mazurek, and I will be taking over for the presentation on debt at high-yield bonds or junk bonds. I want to introduce you to Michael Milken. He is the one who helped to develop the market for high-yield bonds, and he's also known as the junk bond king. He was born in 1946. He's a financier, and he eventually became a philanthropist. He started his career in Wall Street after graduating from the University of California, Berkeley. So his trading in high yield bonds earned him this nickname because he was able to raise a huge amount of money and managed to provide capital for companies that didn't necessarily have ready access to credit through the bond market. Through high yield bonds, he expanded his department, and at the peak of his career, he was earning between $200 million and $550 million a year. He used building blocks of debt, equity, and options to craft hybrid securities to satisfy the needs of stakeholders. And he started with the firm Drexel Burnham Lambert to market these bonds to bondholders so they could sell positions easily. And his career just took off from there. He was able to raise a lot of money. They say in the peak of all of this, they were able to raise billions of dollars. He also benefited, which led to this money-raising ability to leverage buyout firms or hostile takeovers. So again, he worked with Drexel Burnham Lambert to market these bonds. And in 1981, there was a tax law that allowed companies to depreciate fixed assets faster than the previous tax code that was passed in 1954. So it was a larger tax shield through this tax code that let corporations put more cash flow to debt service, which allowed them to borrow greater sums of money. And also the Reagan administration at the time relaxed enforcement of antitrust laws. So they benefited from the circumstances in the 80s. And recent saving and loan deregulation permitted thrifts to invest in junk bonds. And then with companies having relaxed enforcement of antitrust laws, they were able to use debt to acquire firms within the same industry. And a lot of people believed that debt could solve agency problem, which means, managers acting at odds with owners' interests. So the argument was that the large cash flows thrown off by mature corporations invited mischief with the management, and they didn't have ownership in the company, so they were, didn't have as much stake in. Instead of returning the cash to investors or the creditors, the managers might keep that money and, spend it unwisely or don't, not use that money as efficiently. So because of the junk bond market or the high yield bonds, the firm Drexel, it could raise billions of dollars a day from its investor network, which led to these unfriendly takeovers in the 80s. So kind of debt was king kind of in the 80s. T. Boone Pickens, they tried to take over Gulf Oil. These are some of the high-profile, unfriendly LBOs in the 80s. Saul Steinberg sought control of Disney. Carl Icahn tried to take over Phillips Petroleum. Sir James Goldsmith sought control of Ground-Zellerbach. And this $26 billion buyout of RJR Nabisco happened in the 80s by Kohlberg, Kravis, Roberts and Company. That was the pinnacle, they say, of this, unfriendly buyouts. So these financiers, they motivated teams to work harder by sharing ownership of the private company after the takeover. And they say the argument the argument went, rather, judicious use of debt could transform flabby American corporations into leaner, more competitive firms on the world stage. However, that didn't last. In the 90s, debt fell into disfavor. We all recognize this name probably, Rudolph Giuliani, attorney for Trump now, but he was the U.S. attorney in the 80s, and he helped to bring down the Milken empire with charges of insider trading and security law violations. He was sentenced to 10 years in jail, but he was released in less than 2 years. He pled guilty to multiple charges, and Milken was fined $600 million on penalties. After serving his jail time, though, he was diagnosed with prostate cancer, and since then he's donated and funded a lot of research towards cancer, and he continues to be involved with a lot of researches and donates a lot to medicine today. You've probably heard of the Milken Family Foundation and the Milken Institute. He helped start that with his brother to focus on promoting education, the Milken Family Foundation. We've actually benefited from the Milken Family Foundation here in Alaska. I've done a couple news stories of how they've donated to our community. So reducing debt on the balance sheet became the thing to do in the 90s. There's thought transitioned that, debt's not a great thing because LBOs failed, during those hostile takeovers. Cash flows couldn't support those crushing debt burdens. And critics started getting traction that takeovers by management teams without industry expertise impaired the efficiency of the firm that was needed to develop and modernize the company to keep it current. So it became a sign of weakness. And a great company in the 90s was thought to have pricing power, lean cost structures, effective advertising, global distribution channels, a fortress balance sheet. A lot of management teams, they tried to reduce the amount of debt on the balance sheets and increase borrowing capacity. And a lot of the public opinion on this came from Fortune magazine's list of most admired corporations, which during the top 10 in the 90s, they used the Standard & Poor's rating on each firm's unsecured debt. We kind of went over the bond ratings earlier in this presentation. And so some of the most admired firms, I'll read from it. It's the table 11-2 from your book. Coca-Cola at the time, Procter & Gamble, Merck, Rubbermaid, Microsoft, 3M, Walmart, Johnson & Johnson, Intel were some of the top companies from 1990 to 1999. A lot of these companies had AAA ratings, but that's not the case anymore. Actually, several companies that did have AAA no longer have AAA ratings, including ExxonMobil, General Electric, Pfizer, Merck, Coca-Cola, and UPS, all two economic factors throughout the past couple of decades, including the U.S. In 2011, the United States lost its coveted AAA rating. Standard & Poor's knocked it down one notch to AA+. So the only two companies with a AAA rating, Johnson & Johnson and Microsoft, which means that these two companies are viewed to have less risk to meet financial debt than our government. So these scores, they kind of rank these companies on their ability to meet financial debt and their financial health, and the higher the rating, the better you get on borrowing money, and the more money you're able to borrow. So not one of the firms had junk debt ratings, including Coca-Cola, Procter & Gamble, and Merck, and they had really good balance sheets, which again was a sign of a great company at the time. So debt became something that you didn't want to have on your financial statements. And investors and journalists, they viewed it as a sign of weakness, saying, you know, you don't need tax shields to create value like the tax code allowed in the 80s. And that some management teams, they actually tried to reduce the amount of debt because it wasn't a good thing on their balance sheets, and they wanted to increase apparent borrowing capacity, which leads us to the next portion of our presentation in leasing. This is a way to increase apparent borrowing capacity. So next up, David will discuss leasing, which is a form of debt, and then the differences between an operating lease and a capital lease.
I would like to introduce the most common form of debt, which is leasing. Leasing essentially means that a fixed asset owner, the lessor, rents real estate, property, equipment, or other things in exchange for payments that are made by the lessee. And that can range from a couple of hours, like let's say you're renting skis at a ski resort, to almost a century or a century. Let's say huge amounts of property you paid off. But the problem with that is an accounting issue that comes up, which is the timing of when the transaction goes from a rental to a financed sale, and then also how to report that on the balance sheet, since technically it has to be shown as an asset and a liability, but companies prefer not to do so. There's two forms of leasing. There's a capital lease, which is what I'm going to talk about now, and then there's an operating lease, which I'm going to get to in a second. The capital lease is that the cost is included of the value of the asset, and it is also expensed over the useful life of that asset. For example, say you're an equipment owner, you charge a rental payment to recover your 6% borrowing rate, and you do depreciation over 5 years. And then what you would show is $15,000 asset and a $15,000 loan, and both would be amortized over 5 years. So again, a capital lease is treated like an asset and debt on a company's balance sheet. It depreciates over time, and it also incurs interest expenses. At the end of the lease, GAAP defines that one condition must be met. There's either a transfer of ownership, which is number one. The company has the option to purchase the asset at a discounted price, which is number two. Number three is that the term of the lease must be greater or equal to 75% of the useful life of the asset. Or number four is that the present value of the payments are greater than or equal to 90% of the asset's market value. And the other lease that I mentioned is the operating lease. And this remains off the balance sheet since it's just a short-term leasing. And basically it's similar to renting something. So there's no transfer of ownership by the end of it. And that is considered an operating expense, and you can see that in the income statement. It also does not have any effect on cash flow, whether it's capitalized on the balance sheet or reported as a lease expense. And an example for this is that whether you choose to do a capital lease or an operating lease, for this example up here is where in 1976 a purchase is made of an asset of $15,000, and by 1980 it's paid off, and this is the loan schedule that shows this. It includes depreciation right here on the very right side. It shows the beginning balance, the ending balance. It shows what interest expenses are made, the annual payment of $3,561, and the reduction in loan that occurs with that. And you can see here the total of the capital lease is at $17,805. The total of the operating lease is also at $17,805. Capital lease, like we said, they incur interest expenses and depreciation. So you combine those and you get your total. And that's what that shows, is whether you pay $3,561 for 5 years annually, or whether you have a capital lease that adjusts interest and depreciation every year. By the end of it, the difference is going to be zero. So it doesn't matter what you account for. So coming back to that accounting issue that I mentioned at the beginning, there's two things I want to talk about. FASB released Statement 13, Accounting for Leases it's called, in November 1976, and then revised it after a lot of criticism was addressed. Both principles that were used for the original and revised version, one was very strict rules and the other one was rather based on general principles, were unsuccessful and later taken out. Another thing that I want to talk about is consolidated statements, which affiliated companies were combined with the mother company and reported as one entity on the balance sheet, and that would avoid for companies to report debt. Talking about consolidating balance sheets. So consolidated statements present financial positions and operating results for a parent and its subsidiary or affiliates, and basically reports the group as a single economic entity. What that does is that consolidated perspective gives shareholders and creditors a more meaningful perspective than if the business were reported separately. But what critics argue is that combining those obscures financial positions. There's two ways to report an operation with a financing subsidiary. There's the equity method, which you can see in the middle column, and the full consolidation method that you can see in the very rightmost column. The equity method is a slimmed down balance sheet showing a financial leverage ratio of 29%. Then if you use the full consolidation method, you can balloon your balance sheet because you basically combine the firm and you combine both cash, you combine receivables, inventory, you combine consumer loans, you combine plant and equipment. And what that does is it raises the financial leverage ratio up to 55%. So you have a massive increase. So your debt to debt and equity ratio has risen by 26%. And that's why the full consolidation method has erupted. It does usually add debt, so management teams nowadays usually choose not to consolidate figures since it always adds debt. And what that can mean is that borrowing capacity is reduced and financial strength is diminished. And what CFOs would rather do is push off the debt. There's an example I have for you guys too, to unconsolidated related. So what Coca-Cola did in 1986 is what they called the 49% solution. The financial chief officer spun off 51% of US bottling operations into Coca-Cola Enterprises. And the result of that was that Coke was able to remove $2.4 billion of debt from its balance sheets, and Coca-Cola Enterprises was able to borrow more money to finance its purchases from independent bottlers, whereas new debt actually stayed off of Coke's balance sheet. This is summarized as the 50% rule. And despite there's been a lot of criticism about it, as you can imagine, The Accounting Principles Board actually did not address consolidations during its 20-year history, and then the FASB actually still has not released a definite statement after more than 2 decades. One other thing, Statement 94 that FASB actually published in 1987 required the consolidation of majority-owned subsidiaries that were non-homogeneous. That was insurances, real estate, and leasing subsidiaries. This is the end of our presentation. Usually I'd ask you guys for questions. Unfortunately, we can't do that here. So I hope that you guys don't have any, and that we gave you a better idea of how more than a numbers game presented debt to us.